Welcome to Retirement GPS, navigated by Zynergy, your roadmap to a secure and confident retirement. Each week, we explore strategies, stories, and planning frameworks designed to help you navigate the complexities of life after work. From tax planning to investments, income strategies to risk management, our goal is to give you the clarity and confidence you need to make informed decisions. But retirement isn't just about the numbers. It's also about lifestyle, purpose, and peace of mind. We're here to guide you through both the financial details and the personal dimensions of this next chapter. Let's chart today's course.
Welcome back to the Retirement GPS podcast. This is episode 3. And if you're just joining us, we'll be exploring the 10 components of our GPS retirement system, goal-based planning. In this episode, we're talking about budgeting and cash flow, which we like to call the fuel that powers our retirement journey.
And this one really seems like one of the most important components to retirement planning.
Yeah, absolutely, Zane. And I mean, being in on the meetings, you've seen how budgeting and cash flow can really drive a retirement plan either right into the ground or right into the sky. So it's not just about the numbers on a spreadsheet, it's about the lifestyle that actually works when the paycheck stops coming in. And that's what we focus on. I'm your host, Ryan Zacharczyk, the CEO and founder of Zynergy Retirement Planning, and I'm here with my co-host, Zane Belcak. I'm going to tell you the story of Carol, a retired teacher from Monmouth County. Carol was 67 when she came to us, and she'd done a great job. She'd saved well, lived modestly, and was ready to retire. But candidly, she was terrified to actually spend her savings because she had this mentality all through her working life, which most of us have, which is I live on less than I earn, and I make sure I save the difference. And she told us, I've been saving for 40 years. I'm not quite sure how to flip the switch and actually start taking money out. It doesn't feel comfortable to me. Carol had a pension, and as you probably know, teachers have very good pensions and Social Security, but she didn't know exactly how to draw from her retirement savings without actually spending the principal or running out of money over time. She still really had that accumulator mindset, which was work, save, repeat. The idea of not saving to her actually felt reckless. It felt uncomfortable, even though she had more than enough to live uncomfortably.
That seems like such a common issue. You know, we, not me considering my age, but I'm working on it. We spend our whole lives trying to spend less than we earn. And then in retirement, we essentially have to learn to spend what we already earned. That shift is just, it seems really hard for some people.
Yeah, it really is. I would actually say it's the hardest mental transition that people have to make in retirement. It's not actually that difficult to figure out how to spend your time, especially the first year. Most people actually go through what we call the honeymoon stage, where they really enjoy spending their time in retirement. They're free. They don't have to wake up and go to work. There's plenty of fun things to do in the short term. But switching in your brain from being a saver, somebody who puts money away, to somebody who's now spending that money. In fact, there are plenty of times when we actually caught people saving their distributions. So they would take the money out of IRA and they would not spend it all and put it in savings because they're like, well, I can't get comfortable not saving. And we say to them that's completely counterintuitive because you're taking money out, paying taxes on it, and then just putting it into your savings account. Make sure the money you're taking is the money you need to live. So in Carol's case, we worked with her to build a retirement spending plan. We mapped out her monthly lifestyle needs, but more importantly, we mapped out her annual lifestyle needs because most people get wrapped up in the sort of fallacy that whatever I spend monthly is what I spend throughout the course of the year. And we're going to get into this, but that actually can become a big problem. We looked at her fixed and discretionary expenses, and we built a drawdown strategy and showed her where her money would come from year after year after year. And if done right, she would never run out of money. And that's really the goal. Not only would she not run out of money, but the principal, the value that she had in her 403b in her retirement savings would grow over time. So she'd have a much larger nest egg than she has today to leave to her children while she's living off it throughout her entire retirement. And once Carol saw this plan, you could see the tension just melt from her face. She was relaxed. She was happy. She was relieved. And she said to me, now that I know where the money's coming from and what I can expect from it, and really why, I feel free to actually enjoy it. And that's our goal. So today, Carol is living the retirement that she'd imagined. She's traveling to see her grandkids who live in different parts of the country, volunteering on a daily basis. And yes, she even took that Alaska cruise that she's been putting off for quite some time.
So Ryan, I'm going to ask you a question. I just thought of this. What would you say to someone who thinks budgeting is really just difficult or restrictive? Someone that just refuses.
I would say I agree. Budgeting is difficult and restrictive. Budgeting is like dieting, right? Setting a budget in place and trying to live from a budget. Some people find it very easy. We work with accountants, we work with engineers who track every single dime and they're very comfortable budgeting. I would say that's not the majority of the people that we work with. Budgeting is not something that we necessarily want people to do. The same way if you come to a nutritionist to get healthy, they're not going to tell you to go on a diet. What they're going to do is teach you to be intentional with your eating. And we want you to be intentional with your spending. We want you to go into understanding what money's coming in and having intention behind where it's going to go. Not necessarily saving receipts and tracking in spreadsheets. So in pre-retirement, the goal is to spend less than you earn so that you can save money. But in retirement, that flips. The goal really is to spend just what you have coming in, just enough so that you meet your goals so that you're not outliving your money. Without some sort of spending plan, retirees either they spend too little and they miss out on life because they're just afraid to spend and they feel a lot of tension. I've had people with $4 million with me that called to ask if they could go on a $10,000 vacation. And I was like, yeah, absolutely.
Please, yes.
Yeah, please, yes is right. Enjoy it. You've worked hard for it. And then, of course, the opposite is true, spending too much and risk running out of money. We've never had anybody that we've ever worked with have to unretire, i.e. go back to work because of the stock market or because of the economy or because of our financial planning. We have had people had to go back to work because they've overspent. We've had 2 people that actually were running out of money effectively and had to get part-time jobs because they spent far more than we discussed with them and allowed them to spend. And that is my biggest concern. But I can tell you it was intentional on their end because we gave them lots and lots of warning year after year after year when we met with them, telling them they were spending too much, and they continued to do it.
Right. Okay. So that makes sense. That kind of explains why a clear drawdown strategy is so important. I feel like it kind of gives retirees permission to spend confidently.
Yeah, you're 100% right. What we try to do is we say, the money that we've got coming in is yours to spend. Spend it all. Don't feel like any of this money has to be saved. Our strategy is designed so that you can live off everything that you've got coming in. Some of it is guaranteed and some of it is not necessarily guaranteed. But like I said, if it's done right, you should never have to worry about unretiring. So at Zenergy, we help our members build a dynamic retirement plan. And here's how we approach it. We're going to go through the 8 steps for building that spending plan so that you can do it yourself. To our listener, you can do it at home. The first step is knowing your numbers. Okay. Now, again, this does not mean that you need to save receipts and track in a Excel spreadsheet. I'm a financial planner for 18 years, and I can tell you right now, I do not track every single one of my expenses. I used to. We've done it for a period of time, but I found it very restrictive and sort of difficult. It just wasn't my personality. But what we do is we know our annual numbers. We budget every year, and we have tracking apps that actually do follow our spending for us. There are some great apps out there that we can recommend if you would like, that you can set up, link your credit cards to, link your bank accounts to, and then all of your transactions are tracked on a regular basis. So, it knows what you spent. If you go to ShopRite to buy groceries, and you categorize that as groceries, every time you go to ShopRite going forward, it will be through groceries. The 2 apps that we typically recommend for this are NerdWallet and Rocket Money. If that is something that's of interest to you, feel free to go check out both of those apps. Both have free and paid versions, and do whichever you feel is appropriate. And you don't need to even have an app. You just need to know what you spend. So we give all of our people that we start working with a living expenses worksheet. And we ask them, make sure that you understand what you spend annually. The big mistake people make, and a lot of people come to us and they say, okay, well, We ask them for living expenses. Here's our annual bills. Here's our heating bill. Here's our electric bill, our mortgage, and our property taxes. So we basically are getting bills, monthly bills. And I say, okay, great. Where is the rest of it? And they said, no, these are all our bills. And I said, yeah, but those aren't your living expenses. Obviously, you eat, right? So food comes from somewhere, either the grocery store or a restaurant of some sort. And we start diving into what do they spend, both on bills, which we know can be locked in, but then also discretionary spending. I wouldn't call food discretionary by any sense, but it could vary, right? Things like travel, things like gifts. And this is why we tell people, don't look at monthly expenses, look at annual expenses. A lot of times if somebody gives us their spending year to date and they say, this was our spending the last 4 months, January 1st to April 30th. Okay, that's great. That's really helpful because we can really have a good sense of what you're spending on your bills, what your grocery bill is over a 4-month period. But what about holidays, right? Christmas doesn't fall between January and April. Hanukkah doesn't fall between January and April. So if you spend on holiday gifts, that's got to fall into the budget. And really what we do is some people break out the category. We tell people, what do you spend on gifts? And it's not just holidays, it's birthdays. It is a wedding. If you have a random wedding that you go to, you don't have to tell us exactly what you're going to spend. We just need to know what would be a good rough category for it. So if we just had this exercise the other day that we went through with a couple that was in, and they said they spent about $2,000 at the holidays. They spent probably about another $1,000 on birthday gifts throughout the year. And that was what they wanted to use as a budget. And I said, okay, what if you went to a wedding? Where would that come from? Oh, yeah, that would probably be a little bit more. What do people spend on weddings these days? $300 or $400. And I said, yeah, that's fine if you're going to give that generous a gift, but that should be in your budget somewhere. Well, we don't go to weddings every year. I said, I get it. I know that. But you will randomly go to a bar mitzvah, to a confirmation, to a wedding, to events that you really kind of don't expect, but you still expected to bring a gift. So adding a cushion of about $500 a year to that gifting category and taking it up to $3,500 really gives you a good catch-all for not only holidays, not only birthdays, but also one-off gifts that will come up on a regular basis. So make sure you're looking at annual numbers. The other thing that is missed often is vacations. If you did not take a vacation in that budgeting category of January to April, and you say this was our spending, then I'm going to say, okay, great. So you don't ever plan to take a vacation. Oh, no, that's just what we spend in January and April. I'm like, that's helpful, but we need to know what you want to spend on vacations going forward. Okay, vacations are tricky because people may say, this year we have a big trip coming up. That's going to be about $8,000. Typically we spend about $5,000. I say, okay, maybe we need to build in a cushion, especially as you retire. If the goal is to do more vacations or to do that African safari that's going to cost $35,000, we need a bigger catch-all category for that. If you kind of had your druthers and you wanted to spend a larger amount of vacation, we're looking more like for an average. If you do have that one-off safari vacation that's going to cost $35,000, we can build that in for 1 year as a one-off. But if the average is 10 or 15, let's just use 15 as sort of a catch-all for that. Don't forget charitable donations. Those tend to come up for people, and they often don't budget for them. So the second item to include the expected but unknown. Okay, and that's a tricky category because people get really skittish when we talk about the expected but unknown. What do I mean by that? Well, if you own a house or a car, I can bet at some point throughout the year you're going to have a repair. And it may not even be this year, but let's say over the next 10 years. What are the chances you're going to repair your car or repair your house? The answer is probably pretty significant.
And Ryan, this is actually a reoccurring theme that we have in a lot of meetings. They'll give us the expense chart from January to say June, but then they'll add in, oh yeah, by the way, we're making a little bit of a car maintenance purchase in October. Where does that go in on the budget?
Sure. Yeah. And honestly, most people are pretty good about maintenance where they'll say, it costs me about $1,000 or $1,500 a year for maintenance. I say, okay, great. What happens if your brakes go? Because that's probably going to cost you $2,500. The money comes from somewhere. I can tell you it does come from somewhere. If your brakes go, you are going to fix them. You're not going to drive around without brakes until you can afford it, right? Same thing with the roof on your house. If you don't budget for either big home repairs or even home improvements, they're going to come whether you budget for them or not. And I'm not necessarily calling it a budget. It's more of a catch-all spending category so that we know, yes, this money will come out over time. These fall into 4 categories: home repairs or improvements, auto repairs. We have a catch-all we call big item expenses, short-term travel, which would be if I'm going to do some big travel over the next 10 years, because that's when we expect to have health, and then later in life our travel is going to slow down. And then a 5th often missed category is automobiles, right? If I lease a car, it's just a monthly expense. But if I don't lease a car, every 3 years, 5 years, 10 years, 15 years, however often you buy a car, you're going to have that expense, which could run 10, 15, 30, 50, even $100,000. And if we're not accounting for that, that is a big number. So those 5 categories of expenses really need to be caught as part of your expected but unknown. Home repairs and improvements. We talked about a roof. I'm just going to ballpark. Let's say a roof costs $20,000 and you expect you have to replace it every 20 years. The math is really simple. It's about $1,000 a year that we need to account for to pay for a roof when the time comes. If we have a heating system that is about a $5,000 heating system, and that needs to be replaced every 12 years. We can do the math on that and say roughly $400 every 12 years to replace my heating system. And when we start thinking about some of those things, and I'm not asking you to sit there and calculate every major appliance or component of your house and what's going to go and when, and then do math on it, but if you're doing some simple math, you can see $3,000 to $5,000 a year probably should be accounted for maintenance and improvements on your home. If you have a kitchen project coming up that is going to cost you $50,000, break that out. Make sure that may be included as a one-off expense, but that needs to be accounted for sure. Auto repairs. That's a pretty easy one. Most people just put a $1,500 category or line item for auto repairs. $2,000 if you have a more expensive car, $2,500, something like that. If you have a foreign car that repairs can be very, very pricey, you have it done at the dealer, just ballpark. If you know it's $800 to $1,000 to maintain it every year, to get your oil changed, that sort of thing, just make sure then that you're accounting for repairs, big repairs that can come up on an irregular basis. Big item expenses. We like this for things that just may come up that you haven't even thought of. If your child has an emergency and needs some money, we do like to say if a big appliance goes, which would fall under home repairs, but if you want to put it all under one category of big item expense, that's fine. If people refuse to put these irregular categories in, we just put in a big item expense of $5,000 a year just to make sure that we have that catch-all. And short-term travel, I touched on this, but just to explain it, if you're 65 and you want to retire and your goal is travel, that's a big goal of yours, and you say, you know what, I think we're going to be healthy enough, we really want to do some big travel in the next 10 to 15 years. I think during that time we're going to spend $20,000 a year on travel. After that, it's going to be more like 10 just to go see the grandkids and maybe go to Florida once a year. Then fantastic. Then just make sure that's accounted for. We'll build a budget of $20,000 a year for the next 15 years and then have that drop down to 10 for the remainder of your life. And just account for that additional travel. And then finally, our last category is automobile purchases. And typically in this case, we say to our people, how often do you buy a car? And the answer we often get is 6 or 7 years. Great. How much do you spend on that car? And the best gauge of that is, what did you pay for your last car? And if they say we spent $50,000 on the last car, okay, great. When did you purchase that car? In 2024. Now we're recording this episode in 2025, which means the next time they're going to buy a car, we would say is 5 years from now. And we know they're going to spend $50,000 adjusted to inflation in 5 years, and then run where they're going to purchase that car every 6 years at that same price. Just a ballpark gauge. There's no guarantee that's how they're going to buy a car, but it is accounted for now as part of our spending program over time. A lot of information there, Zane. Does that all make sense?
Yeah, it makes relative sense. It's good to always plan for the future, especially with these big ticket expenses.
Yeah, the big ticket expenses are missed often because people will say, this is what I need to live off of, and then I'll get random calls if they haven't budgeted properly and say, well, my property taxes came up and I need this. And I said, that should be part of your distribution program, that you should be taking that money and having it set aside for those purposes. So the next step is match your guaranteed income to your expenses. So sum up all of your guaranteed income in retirement. Those are things like Social Security, annuities, pension plans, or any sort of insurance distributions or things that we know for sure are going to be coming in. And the great thing about those is those tend to be guaranteed income sources. Once you start Social Security, you know what it's going to be. It increases with inflation, and it's guaranteed by the U.S. government. About the best guarantee we can get in this world. Effectively the same thing with annuities, pension plans. So total all of that up and see what that number is. And then when we compare that to that annual number to our annual expenses, our next step number 4 in our process, is mind the gap. So the gap is what we are focused on as retirement planners. So we have our guaranteed income sources, which is in retirement almost certainly less than our living expenses, right? And now we have a gap. And our job is to fill the gap. Now, really the key to success in retirement is trying to get that gap to be as small as possible. And I'm sure a future podcast episode, we're going to talk about how we can kind of reduce that gap. One of the best ways is we like to have people pay their home mortgage off in retirement. If you have no mortgage in retirement, if that's possible, that would dramatically reduce your gap. And reducing your gap will create a lot more certainty in your retirement planning. But we do then need to start thinking about drawing from our retirement accounts, our investment accounts, to fill that gap. All right. Number 5, adjust an account for inflation. Do not forget that your costs will go up over time. The example I like to use for people, most people get it once I say it, but they just don't think about it leading up to retirement planning. What did a stamp cost 25 years ago, right? What did a movie cost? When I was a kid, and I mean, it's going to date me a little bit, but I remember spending $7 on a movie, and I remember like the discount, like afternoon matinees were $4. I just bought 3 movie tickets for my wife and my son to go see a movie, and we paid $20 a ticket. That's inflation right there for you. I can tell you right now, your property taxes 25 years from now will probably be more than double what they are now.
I always think about groceries, Ryan. You compare the prices now to even 10 years ago, it's completely different.
Yeah, I'll tell you, if you compare the prices now to pre-COVID, which was only about 4 years ago, it's very different. Talked about eggs last episode. Eggs are...
No, exactly.
Yeah, and you know, that's exactly what you're going to see. It's not just going to be property taxes and movies. It's going to be the things that you need every day. And people who forget about inflation do it at their own peril, because it is sort of a slow grinding tax on your distribution. So we have to account for it. Make sure you're inflating your expenses over time. We always do when we do our financial planning. Number 6, distribute the gap from investment accounts. So we like to see roughly a 4% distribution from your investment accounts. Really no more than 5% if we can help it. We may go a little more than 5% for a couple of reasons. Number 1, we do have a program where you can draw 5%, but you may have to cut during bad market environments. The other option is if you draw more than 5%, you can do it for a short period of time. If you have higher expenses in the short term, but in the future they're going to be a lot lower, we can draw a little bit more in the short term. But we're really looking for that 4% number. That's kind of our golden number in retirement. And what I mean by that is if you have $1 million that you've saved for your retirement and you want to now draw from that account, you can draw $40,000 a year, right? So 4% of $1 million, $40,000. That's your comfortable number.
And Ryan, I'm just thinking of a little bit of an example I just want to throw at you. What if we had $1 million in an account, like you were saying, but the person in question was like 80 years old and they were worried about running out of money? Is that 4% still stable, or can we take more?
Yeah, it's a great question. We just actually had this come up recently where a woman reached out and was worried that she was overspending because she was spending quite a bit. And she was spending over 5%. She was spending about 5.7%, which in financial planning terms is on the high side. But to Zane's point, she was actually 81 years old. So we have some flexibility there. To be honest with you, the 4% rule, 5% rule, these are all math formulas based on life expectancy in a certain amount of time. It gets very technical with financial planning. It's not a hard and fast rule. If you're in your mid-60s and you're drawing more than 5%, you have a very high probability of running out of money. We don't want to see that. Now, there's a probability you don't run out of money, that you have a really comfortable retirement if things go your way on the investment side, but we don't want to count on that. We're not playing roulette with your retirement. We want certainty in retirement, as much certainty as we can get in this world. And in the case of this woman, I said, you're perfectly fine. You drew 5.7% last year. You're pacing to draw 5.2% this year. I'm not worried about it for the time being. If it becomes a problem, we'll talk about it. But for now, you're okay. Keep doing what you're doing. And the reason why she's overspending is because she's doing a lot of travel and she's enjoying that travel. She lost her husband a couple of years ago and she's doing a lot of travel with friends who are also other widows. And I feel like it's really important for her to do that. I don't want to take that away from her. So it seemed like a really good opportunity to spend a little bit more, knowing in the future that spending will come down. Number 7 is account for taxes. So we just talked about $1 million portfolio and you're taking $40,000 a year. That's a gross number. So if that $1 million portfolio is a 401k, taxes are going to be withheld from that. And you need to make sure that you're accounting for taxes and ideally having them withheld from your distributions. And then you're living off the net of that. All right. With our people, and we're going to get into taxes another time, but we look to do Roth conversions. So we have a lot more after-tax or tax-free money. And we also look to see where we can manage taxes to keep the brackets low, such that, you know, when they are distributing, more of their money stays with them as opposed to going to Uncle Sam. And really the last step here is to stay flexible. Your plan isn't set in stone. And we fully expect that there will be spending changes throughout your retirement. Every year that we do planning for our people and we go through our GPS process, it's a guide, it's a guide, it's a guide. It's always about, this is what we expect and we're going to change and course correct. It's just like the GPS in your car. It's a map to the direction you go. If you make a wrong turn, it will readjust and move you back in the right direction. That's exactly what we're going to do. If you overspend in 1 year and we've had people spend 8%, and we have to sit them down and say, you overspent. You can't keep doing this or you will run out of money. And the next year they're back spending 3.5%, 4%. Great, right back on track. So understanding how much you can spend and making sure that you're doing that. And if you get off track, it's kind of like being on a diet and eating that box of donuts. Maybe not a box of donuts. I don't know. Zane might eat a box of donuts.
We have some in the kitchen. I'm going to have some later.
Yeah. 4th of July donuts. So being on that diet and falling off your diet, right? Maybe not eating a box of donuts. It's a little bit extreme, but having Oreos and milk or something like that when you're on a diet, the next day you should wake up and say, okay, not great, but it doesn't mean all of a sudden I failed completely. Right? I'm going to restart today and get back on track. That's what GPS does in your car. That's what GPS does at Zenergy Retirement Planning.
And for pre-retirees, people relatively younger, maybe around my age, we still emphasize the basics, spending less than you earn, living within your means, and really just building some sort of margin into your budget so you could save aggressively.
Yeah, exactly. It's like building the engine before a road trip, right? The better you plan in your working years, the smoother your retirement ride will be. So we really see budgeting and spending like the engine of your retirement years. We talked a lot about budgeting. We talked a lot about cash flows. So what are we going to do? Action steps for today. First, download our retirement living expenses template. Use it as a map, a guide to understand what your annual spending is going to be, right? We want to know what annual numbers are. Monthly numbers are great, but annualize them. Multiply all your electric bills by 12, and that way we have an annual number. And don't miss things that are irregular, such as holidays and gifting. Number 2, what are your guaranteed income sources? Social Security, pension, annuities. Make sure you know exactly what you're going to have every month coming in. Number 3, mind the gap. Determine what your gap is. Determine where you're going to pull that money from, and try to live within that 4 to 5%. 4% distribution rule is really what we want to see. Don't go any higher than 5. And lastly, if this all seems overwhelming and a little daunting, which I know this can be a bit of a challenging component. It's really important, but it can be a bit challenging. Don't be afraid to call a financial planner. Meet with somebody who can help you through this process and discuss what exactly you're going to be spending, help you organize it, understand what your guaranteed income sources are, and fill that gap. And it's something that we do as Zenergy with people all the time, and we're happy to help.
And if you're interested, we actually have a blog that's coming out on a regular basis with topics such as these, which you can also explore. We also have social media accounts which relatively do the same.
Yep, well said, Zane. Our blog has great content on it on a regular basis, weekly basis, tied right to our podcast content. In addition, our social media on Facebook, LinkedIn, and Instagram will touch on these individual topics as well. So be sure to go on, follow us, and check out the blog posts. But join us next time as we dive into our GPS component, emergency reserves. Don't forget, make sure you hit the subscribe button. Make sure you are a part of it so that you're getting notifications when our new podcast is coming out each week. And until then, keep planning and keep your retirement on course.
Thank you for listening to Retirement GPS, navigated by Zynergy. To explore today's topic further, visit our blog Mile Markers at zynergyretirement.com/blog, where we offer detailed strategies, examples, and downloadable tools to support your retirement journey. Follow us on LinkedIn, Instagram, and Facebook at Zynergy Retirement Planning for weekly insights, checklists, and planning reminders. If you found this episode helpful, please subscribe, leave a 5-star review, and share it with someone planning for their future. Until next time, keep navigating toward a confident retirement. This podcast is for informational purposes only and is not intended as investment, legal, or tax advice. Listeners should consult their own financial, tax, and legal advisors before making any decisions. Zynergy Retirement Planning is a registered investment advisor located in Red Bank, New Jersey.